Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of October. The third quarter has been a tale of two cities: politics, geopolitics, trade relations, strategic alliances, immigration, central bank independence, and for argument's sake, anything that could be considered influential to economic activity has been subject to revision, debate, and/or change. Ex ante, a tsunami of such magnitude should have created massive economic waves hitting global stock markets hard. Paradoxically, global economic activity around the world blazed through the storm, displaying resilience and adaptability. Bullish equity markets across the globe were driven by earnings growth and multiple expansion, the former led by the US, while the latter was commanded by China. US AI revolution continues to propel growth, where American large language models account for 99% of the global market share. Furthermore, according to JP Morgan, 90% of capital expenditure growth over the last 2.5 years was attributable to AI-related investments. At the same time, China has become the frontrunner in global robotics, a superior positioning which is anchored by the nation's modern electrical grid and unique access to rare earth elements. A cohort of investors is becoming concerned about the risk of a market bubble. However, not all sectors and companies can be treated the same way. Hyperscalers, for example, continue to heavily invest in AI infrastructure funded by operating cash flows instead of debt. However, young AI firms, new nuclear energy players, and new ventures funded through private markets, where information is scarcer and valuations have skyrocketed over short periods, are areas on which we remain cautious. A persistent macro theme is the increasingly fragmented geopolitical world. President Trump's attempt to reach a ceasefire between Russia and Ukraine was not only unsuccessful, but also followed by Russian military escalation against Ukraine, along with a wave of Russian incursions into European airspace, an act capable of turning the conflict into a regional one if NATO shoots down Russian warplanes. The Middle East has not fared any better, where the horrific war in Gaza has already claimed thousands of lives and has made vast portions of Palestine uninhabitable. Meanwhile, 5 different Arab nations have been struck by Israel since hostilities began. The White House plan to end war following a meeting between Trump and Netanyahu brings a glimmer of hope to the situation. However, the deal's inner workings are still in early phases of negotiation. With all these developments in mind, what are the key factors to keep an eye on in the last quarter of the year? First, US labor market and monetary policy. A sharp increase in the unemployment rate could risk sending the economy into recession, triggering a market sell-off. The Fed's easing cycle and accompanying behavior will be key to establish how well the Fed is able to fulfill its dual mandate, as well as to remain and behave independently. Second, Eurozone challenges. European leaders are struggling to govern their countries, with the UK and France likely struggling the most to rein their budget, while once envied Germany manufacturing sector is now threatened by the end of cheap Russian energy, rising Chinese competition, and tariffs on US imports. On the bright side, Germany's prosperous service sector and low fiscal deficit provide a degree of flexibility, while buoyant European stock markets and companies are attracting global capital flows. Third, Chinese economic activity. Huawei's push to mitigate dependence on NVIDIA chips is a Chinese strategic necessity, in addition to the gateway to securing its global market share in the AI infrastructure race. Another important milestone is the successful trade agreement with the US to invigorate below-trend economic growth, where no short-term substitute exists for American consumption in an export-reliant Chinese economy. We maintain portfolio duration within a 5 to 6 year range, the section of the yield curve which we consider most attractive in terms of risk-adjusted return, and well in line with our benchmark. The continuation of the monetary easing cycle in the US is expected to have a positive impact on portfolio performance via price appreciation, while remaining in the value of the curve avoid excessive price volatility present in longer duration bonds. We also maintain our investment-grade allocation to high-grade government bonds and corporate bonds, with an emphasis on diversification and credit quality, keeping volatility constrained. Persistent income generation endures as the key performance driver, acting not only as a source of returns, but also as a cushion in case of spikes in variability in the equity market. Credit spreads in the high-yield space linger at the lowest level in 20 years, leaving the sector exposed to credit spread widening. Our quality position seeks to limit credit risk exposure. Equity allocation was increased further, bringing portfolio positioning to neutral versus the benchmark when it comes to regional, sector, and market cap allocation to further participate in positive market momentum. Along the same lines, covered call strategies were replaced with long-only equity managers. Equity positioning is consistent with the signal provided by Insigneo's recessionary indicator, which observed a decline in the 6 months recession probability in the US from 64.79% a month ago to 18.48% in September, supporting our current positioning. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.